All right, welcome everybody. Looks like we're right on time, 11 a.m. Pacific. And want to make sure you can hear me okay. And in fact, let me do this. If you can hear me, why don't you go ahead and just, raise your hand or throw a note in there in the chat. Want to make sure before we actually dig into this. Yep, getting a thumbs up. Thank you. Thanks for that, Ram. I see, uh, I see a lot of people joining. It's always interesting how that works. Right on the button, you get a lot of people coming on board. So thanks for joining us. And let's see here. Do I dare turn on the camera? Sure, why not? Let's take a look here and see if the camera's working. Yep, all right, there I am. We're in the AltaVest shirt. Hopefully you can see that. And we're going to go ahead and jump into the options trading demo here. We'll look at these pre-built automated strategies for option spreads, our one-touch responsive trade alerts, and then how we can automate risk and profit-taking controls as well. But before we jump in, remember we're speculating and we're trying to make money as we speculate with prices moving up and down and sideways. And there's always risk when you're trying to make a profit. So do take a moment and look at that risk disclosure. An important thing to keep in mind is that trading capital should be risk capital, and that past performance is never a guarantee of future results. And a little bit about AltaVest. We are a registered introducing brokerage firm since 1997. So doing this 26 years, having traded tens of millions of contracts over those years. And that's yours truly there, and a little bit younger yours truly with some of our trading colleagues on the S&P 500 options pit. These were some of the floor traders, the brokers that actually filled and executed our millions and millions of orders. But of course, a lot of that is, well, basically it's all done electronically now. Part of what we're going to talk about. Of course, we're in a regulated industry, being a brokerage firm. We're audited and we're members of the NFA and registered with the CFTC and located in California. You might have seen some of our presentations and materials in the past over the years, especially since the 2020 when everything kind of went online. But we did a lot of these presentations in person actually before then. A little bit about myself. I'm Eric Gebhardt. Been doing this 30 some years now. Co-founder of AltaVest. I had my license back in 1991 for futures and options trading. I have my business degree from University of Southern California, the Trojans. Started in the securities industry many, many years ago with my Series 6 and 63 licenses. And what that means is you can work with mutual funds and annuities and insurance and so forth as well. And I also have my Series 65 investment advisor law license as well. So with that said, introductions out of the way, how about I turn off the camera? You have a little more room on your screen that way, and you don't need to see me here talking. Although if you want to, let me know, but I don't think you need to. Okay. Here are the top 3 barriers that we've kind of taken the pulse of our client base over the years, and this is sort of the common thread among traders. A lot of noise. I think that's a big one. A lot of noise and opinion, storytelling, as they call it, narratives, price targets. Very, very crowded environment, convoluted, I guess in some ways, contradictory. Here you have a May 9th. Home Depot could be a big win. May 16th, they've just posted their worst revenue miss in 20 years. And then you get, they're talking about Elizabeth Holmes being the next Steve Jobs. And of course, now she's in prison. And then they're talking about Sam Bankman-Fried being the next JP Morgan, and he should be in prison. So a lot of storytelling narratives. We'd rather not get too heavily involved in that, although we will talk about some of our outlook here later in the program. And I think that's much different than the storytelling narrative because there's a lot of data behind what we're going to talk about. Worthless price predictions. This one always cracks me up. It's a little bit older from last year, but Bitcoin is either going to 250,000 or 5,000 next year. Okay, well, I guess I guess it's on its way closer to 5,000 right now, but certainly not a helpful prediction there. How about the second barrier? Time and discipline. Well, if you're going to be screen watching and actively trading all day, you're going to need to put your time into it, put yourself in front of the screen. But a lot of us don't really have time or would rather not do this. This person says they sit in front of the market from open till close in front of their computer, watching the market close, watching every once in a while, even after market hours. I don't know. I think this is probably a wise way to look at it. All we have to decide is what to do with the time that is given to us. And so I think that's a fair assessment and how we kind of looked at ThetaTrader and what we're going to show you in just a bit in terms of why it exists the way it does. How about the third barrier? Us, really. We get in our own way with our emotions. We're not, Dr. Spock, we're not Vulcan, so we have emotions and we ride that emotional roller coaster. I'm sure we've all felt this where you have trades working well, you get excited and euphoric, and they get despondent when things aren't going well, and then you just kind of go up and down that curve. But you want to control those emotions as best as possible. And it can be expensive trying to convince the markets that you are right. So it's a great quote from Ed Sequoia. He's in Market Wizards. There's a Market Wizards 2 as well. Now, how about algorithms and technology? Can we compete with that? Can our emotions compete with algos? Well, remember, this is our trading competition. It's not really people like us across the country or the globe sitting behind their desktops or on their apps trading. That's not really your competition. It's this automation, algos, AI, whatever you want to call it, automation, risk controls, profit controls. And algo trading is 90% of the US equity trading volume. That's according to JP Morgan estimates, or systematic trading, if you want to call it that, or black box trading. Now let's look at insurance companies and how they might look at trading, or how they might even look at their business model, really. They're paid premiums to assume risk that others don't want. So they're selling and managing time. They're insuring themselves by hedging. They're patient along the way, and they have favorable long-term probability and math really on their side. Statistics, actuarials, just data, number crunching. That's really what they do. Then they come up with their results, and then you end up paying them, and they take that risk. Of course, we can collect premium too when trading options with these premium collection strategies where we're looking for lots of base hits and selling options and collecting the premium that people are paying. We need to be consistent and patient with this approach. Of course, we will have losing trades. You need to manage those trades. Manage reward, that's just as important. Don't overstay your welcome. You'll need experienced personnel behind you and the correct tools to do this. It can be very complicated otherwise. And again, lots of base hits. We're not going for those grand slams. We're not trying to crush it with, 5,000% returns and that type of, hype and excess that you see about and hear about all the time. So these are short option strategies. They can be non-directional, bullish or bearish, and they target outcomes with a fixed risk and profit potential as well. So these are called credit spreads. Every position is insured or covered, predetermined risk and reward, and they can even be non-directional in nature. You don't have to have a bull market or a bear market for some of these strategies. And then looking at probabilities with options trading, one thing we're going to look at here are the couple of the Greeks, they call it. It's just really, they use Greek letters to describe some of the character traits of options. And it can get it can be granular and a little bit deep into the weeds, but we're going to keep it simple. We don't need to overcomplicate it. So delta, that simply is representing how much the value of the option changes with a change in the underlying asset price. It's also the approximate probability of that option expiring in the money. So a lot of traders use delta in that regard, and so do we. So example here, 0.25, if that's the delta on an option, that means there's a 25% chance it will expire in the money, but a 75% chance it expires out of the money or worthless. And keep in mind, delta is always moving up and down with price of the underlying asset, and of course as time passes. It is not the probability of a winning trade, so that's important to keep in mind as well. And the other one here we're going to look at is theta. It's really sensitivity to time, or time decay is one way to look at it. Remember, every option has limited life. It does expire. It will expire at some point. It's called a wasting asset. So time in options talk is really referred to as theta, and it's a negative number, and it equals 1 day of time decay. So if you have an option at 10 points and the theta is negative 0.05, and that would mean all things remaining equal, just based on theta decay alone, the premium would drop to 9.95. The next day after that, it would drop to 9.90, and so on and so forth. So that's called theta decay. So you can see if you buy something at 10 and as the clock is ticking, it's losing value. That's what that means. Unless, of course, you get a favorable move in the underlying asset. But even then, and I'll show you why in more detail, even then it may not make a difference because the time value might erode more quickly. But this is what it looks like here on a graph. Simply put, you have 9 months or 8 months or 7 months, and you get closer to zero, and then the value or percent of that premium remaining drops and drops and drops. That's called theta decay. And we know that Wall Street pros will trade multi-leg option spreads to collect premium. So they're selling spreads and collecting a net premium. This woman here on CNBC, she had a great presentation, so I've used it here a little bit of late because she actually verbalizes things very clearly here. And there's a link to it I'll show you in just a second. But she mentions here, an option spread calls for buying and selling different contracts, a common way for investors to hedge risk and volatility, and it's usually cheaper because you can offset your cost by the proceeds from different contracts. So she's referring to option spreads. And it's been used by Wall Street professionals for decades, and she's absolutely correct. So can algos be used for professional style options trading? Yes, they can. So we're going to use some automation to collect option premium, whether conditions are bearish, bullish, or non-directional. There are strategies available and can be customized and fitted to any outlook. Here's an example. If you're bearish, you might sell a call spread on the S&P 500. So you're bearish on the stock market. And this could be, or moderately bullish even, or it could be non-directional. So this strategy would work in any one of these three environments. And here's what it looks like. Here's the S&P 500. It's moving up, it's dropping, it's moving up, and maybe now you think it's time for the market to take a breather or perhaps even drop. So you could sell an out-of-the-money call spread, represented here by this red line, the 45.50 call that you sell for 4.5 points. You collect that money, put it in your pocket, and you would simultaneously buy that higher strike price call, the blue line. That's a 45.70 call, but you pay less. You pay less money for that. You only pay 2.25. So the net result is you collect $112.50 in this example, minus any fees, of course. And so that's the premium that you collect for selling that spread. And here's an example of the opposite. You might sell a put spread. That could be a bullish condition or even moderately bearish or non-directional. And again, just the opposite. Here's the put spread that you're selling. You sell that one strike here for 3. You buy the further out of the money to cover it, cover some of that risk. You pay $1 or a point on that, and the net result is you collect $100 or 2 points. And these are not naked option spreads. Everything is hedged and covered, as we say. Your maximum risk is capped in advance. These are covered. No naked trading, no naked furless creatures allowed. I do like those cats, though. They look like, I don't know, from another planet. So I don't know. I like keeping that in there. So this is a good thing to remember. Two big advantages to doing covered spreads. The risk is predetermined, so you do not have unlimited risk. And also there will be no margin calls. You're not going to be forced out of a position if the market moves against you. So two big advantages for trading covered spreads only. And here's a good way to look at that. This woman here has a text apparently from this guy's phone, and she says, "Who is Margin, and why does she keep calling you?" So let's remember that margin calls are not calls that you want to receive. And then here is an example of a condor called an iron condor strategy. And it's simply a combination of the put and call spread that we just saw. And it's a simultaneous execution of both of those spreads. And you're collecting premium from selling the call spread above the market and selling the put spread below the market. And that's how that works there. And then you can see the market's in this range between the upper boundary and lower boundary. And then if it stays in that wide margin of error, then that trade should work out well for you. And here's our proprietary strategy. It's called, well, actually people say that's really unique, or that's really clever, or weird. And that's fine. That's sort of a compliment. We came up with this years ago. We call it a dragonfly with 6 legs to collect premium. And it's a non-directional variation on the iron condor strategy. And here's what it looks like. And again, you have, let's say the current market is trading here, and you might decide to place this dragonfly with the calls and the puts. And let me walk you through this. You would sell 4 of these calls here, buy 3 further out of the money, and then buy 1 closer to the money. And then the same structure on the downside with the puts. You sell 4, and you buy 3 further out, and you buy 1 closer to the money. So you do this for a net premium that you collect. And you'll notice here, if you can't quite see the screen, I'll just point out, you sell these 3,200 puts in this example, but you buy 1 3250 put. So you can see this one that you're buying here is 50 points closer to the money. And the same with the calls. You buy this 4010 call compared to the 4 that you sold at 4060. And again, it's 50 points closer to the money. It doesn't always have to be 50 points, but that's what the algo chose on this day. And really what I'm getting at is it changes the whole risk reward dynamic of a position like this. If the market starts moving against you closer to, say, the call side, this one call that you own has a much higher delta compared to the 4 that you sold. So it will react more to price movement, and theta decay won't impact it as much because it's closer to the money. But we'll get into that here. I'll show you that here. There's other positions that you can build if you're bullish or bearish, and we'll show you that in the demo. But here's the question a lot of you probably have right now. How would you even know how to create kind of a spread like that, whether it's 2 or 4 or 6 legs? What market would you apply it to? Which strategy would you use? What would be the correct price in terms of your entry timing? Then how would you manage the risk and the profits? And of course, that would be your exit. So we're going to show you a demo of ThetaTrader. This is our software that we've created for pre-built option spreads. Our proprietary algo builds what we call theta trades every day. And these are professional strategies that we just talked about, the multi-leg spreads for any market condition. And then we have automation for risk and profit tracking. It's something called the RTI, which is the risk thermal indicator. And it's color coded, and I'll show you how that works. All right, let's go ahead and jump into the demo. If you don't mind, give me just a second here, and I can switch screens. All right, I think we're looking good. From my end, it looks like you're all viewing the correct screen. So this is the dashboard for ThetaTrader, and I'll give you, in fact, let's see here. Are some of you asking? Yeah, and by the way, feel free to ask questions along the way. I don't always get to them right away because I'm in the middle of this, of course, but I do want to make sure that you ask questions along the way, or if you had anything that you need to say, that's fine too. And let me see here. I just want to make sure I'm not getting too far ahead of myself. Okay, this is your Theta Trades section here. And this is just a demo account, by the way. A real account would look very similar. All this would look the same, but some of these items in the menu would be different. But these are the Theta Trades for today. These would be any of your open short option strategies or open sold positions here, and any open bought or long positions. And then here's your account info. So this is all integrated with your AltaVest trading account. So ThetaTrader is an AltaVest software solution. So AltaVest clients, you have an account with AltaVest and use ThetaTrader. And these are current price quotes. So you can see here there are bullish strategies and bearish and neutral. So these are all basically pre-populated. And we focus on three markets: the E-mini, S&P 500, NASDAQ 100, and Russell 2000. And there are some tremendous advantages to focusing on just those three stock market indexes. And I'll get into some detail a little later, but really the basic gist of it is that's where all the volume is. So that allows you access to these types of option strategies that you can't typically do on a usual or more typical stock or individual stock. There's just a lot of volume. So we can look at an example here of a theta trade for today. We looked at the dragonfly and the condor just a few minutes ago. So you can see here are the, in fact, can you see that okay? Maybe if I expand that a little bit. Here are today's theta trades, anywhere from 17 to 59 days till expiration. So these are all the different expirations available that the algorithm has chosen and selected strike prices. You can see by hovering over it, says sell the iron condor there, and those are the strikes, the puts and the calls on that position. And this here is your maximum profit potential at expiration. And this here would be your targeted annualized return at expiration for that trade. Keep in mind that number here is just to compare like this trade to any of the other trades. Not to suggest you'll be making 235% a year by placing that trade. So it's really just a relative comparison, one trade to another. So you can evaluate this one condor versus a different one. But also note that any condor that has fewer amount of days compared to another is going to have a higher targeted annualized return, because of course with fewer days it just assumes you turn that trade over and over and over for a whole year, and that's how that number is derived. So anyway, well, let's look at this one here. I randomly, you just pick the trade with the most amount of time. That's what I typically do during these presentations. So we're going to drill down. First thing I like to do before I get into this is I'll look at a graph. So here's an overview of where the market currently is trading. Here's the call spread you're selling and the put spread that you would be selling. So that wide margin of error there, and if the market stays kind of in between this area, then that trade should do well. So it has 59 days till expiration, settled at 2.4 points. The net premium you're going to collect by selling that spread, your put risk, your call risk, commissions, capital, cash required, profit potential, targeted return on cash, and then we talked about the targeted annualized return. And here's one thing I want to point out. The put here has a delta of 9.8. So the math tells us there's over a 90% probability this option here is going to expire out of the money. So that's why the algo says to sell it. Sell it to someone else, have them pay the premium to you, and hopefully let it expire. Let them hold the bag as it expires, and you collect the money for it. That's the idea. And then selling the call here, 6.38% delta. So 93% probability that this call option you're selling expires out of the money. And that's how we look at those deltas in this case here with this spread. Cash required, profit potential. People might point out, I can only make a maximum of, let's say $100 here, but I have to put up $900. Well, keep in mind, that's what the deltas suggest, and that's offering this higher probability outcome according to the math. The math says there's a real high chance that this particular, trade will work by selling these options. And that's why the algo has chosen this particular trade. And we always get out of these trades before expiration. You'll never hold these till expiration if you're doing it according to the automation, and I'll show you that. Always defaults to a sell and always a quantity 1. If you change the quantity maybe to 3, you can see your cash required, profit potential move up. You change it up and down. I'll just do 3 of these just in there, leave the price the way it is and place the order. And it just assumes you're filled because it is a demo account, and it's just that easy. All right, let me go back and let me show you the Dragonfly, and then we'll look at some really great simulations here. All right, here is the Dragonfly, and we'll look at the same same expiration here that we did on the Condor. It takes a few minutes to pull up all the different strikes from the exchanges and whatnot and all the data. And again, let's look at the graph. So here's the call side of the Dragonfly. Here's the put side of the Dragonfly. You'll notice the one call that you buy is 50 points closer to the money compared to the 4 that you're selling. And it doesn't have to be 50. It does change. We don't know when it's going to change. That's what the algo decides. And we'll look at the same kind of data here, days till expiration, the premium, your risk, commissions, capital, cash required, profit potential. You'll notice the targeted annualized return and targeted return on cash are a little bit less compared to a Condor, and that's typically the case, and that's because, again, you buy this call and you buy this put, so that cost you money. So that essentially is like purchasing additional insurance on the position. And while it does cost you more money and sort of reduces your profit potential in terms of just on a linear outlook, it does have benefits, and I'll show you that in some of these other demos in a second in terms of changing the risk reward paradigm of the trade. It can be very favorable compared to a Condor because of that extra insurance you have. And again, you're selling these 4 puts here. You can see the delta 9.8. You're selling these 4 calls, and then you're buying these other puts and calls here to cover or hedge that position. So for every 4 calls that you sold, you've also bought 4 calls. They just happen to be at different strike prices. And I want to point out too that everything in ThetaTrader is net of commissions. So all of the percentages and dollar figures are net of commission. We'll do a quantity of 2 of these. You can see the cash required moving up, profit potential moving up. We'll go ahead and place that in this demo, and you can see there it just assumes you are filled in the demo. Now, this is a really, really great feature. I've never seen it before anywhere else, and it's been quite a few years, and I've looked too. I've never seen this. We have a kind of a time machine. You can go backwards in time, and you can back test these option spread strategies. Give it just a second here. So you would do that here under the trade simulator. You just click simulator and it would pull up another page here where you can choose the dates. You can go backwards in time and choose any date you want, and then choose any of the strategies in any of the markets here, and then kind of go backwards in time. And I've loaded a few of these just to save some time here to kind of get to the point. Let's scrunch that down so we can see. So here is February 1st of this year. Here's the end of month March expiration, Iron Condor. And use these buttons. You can play, and see how day by day you can go backwards one step at a time, forwards one step at a time. And you'll notice you can see as each day goes by, ThetaTrader is monitoring the position with something called the RTI. That's the risk thermal indicator. And it's green right now, and all the colors are described. I'll show you later, but green means good and do nothing. And you can see the trade's a little bit negative. The P&L is negative, but then it turns green. So it's becoming profitable, and that's because the theta decay is working. So you can see the market's kind of going sideways. But remember, that's good in this case because time is ticking off the clock. And those options have less and less time every day. And then here you go, it turns blue. What does that mean? It means take profits. So the algorithm says that's the time you take profits on this position. You've captured enough reward and you can move on to the next trade, take your capital and move elsewhere. And now here is the real key with this. You can automate this so that when it turns blue, ThetaTrader will automatically place that order for you to close out that position. And I'll show you how to do that in just a second. But that's kind of a typical condor that actually ends up, working well. And we'll look at the dragonfly. So this is the dragonfly. This is the March into month expiration on February 1st. And this was also on February 1st. So imagine you did a condor and a dragonfly on the same day. That's all we're showing you here. And it turns blue on March 3rd with 29 days till expiration, and that's a profit-taking signal. And let me just see here. Let me compare the profit signal. Same date, March 3rd. So they both turn profitable on the same day, which is fine. So that's a typical dragonfly position working out well. Now let's look at some of the differences between a condor. Here is May 3rd of this year. Here's the end of month June expiration, and here's a condor. And again, do nothing. Green means good and do nothing. Turns yellow, turns orange, and that's elevated risk, but still do nothing. And you can see the trade's losing a little money now. And then it turns red. So here you have a losing trade. And that's kind of a typical example of a losing trade with the condor. You can see why. The market's moving higher and higher, getting really close to those upper short calls that you have on this position, and said there's too much risk, cover the risk, take your loss and move on. And so that was the condor on May 3rd. Let's see here. Thought I had the same one. If not, I can load it up. Just a second here. Actually, I think that's fine. We'll just leave it the way it is there. Just want to demonstrate the loss and leave it at that. But I do have a couple other ones here I wanted to show you. Let's take a look here. Yeah, that was May 3rd. So here is on, let's take a look here. What's the date on this one? June 28. Okay, so here's a condor. Let's look at what happens here. So that turns profitable on August 11. Okay, and now let's take a look here on the Dragonfly for June 28. Let's take a look here. We just go back. Okay, so this is how you would do it. You go to, let's see here, June 28. And we're looking at the Dragonfly compared to the Condor. And we'll play that. And look at that. It gets out on August 4. So that's about a week earlier. So there's a good example of the difference between a condor and a dragonfly sometimes. A dragonfly may mature more quickly than a condor and allow you to get out and take your profit on that position and move on, to a different trade. So that's one of the benefits of the dragonfly. Just wanted to point that out. And then here is another one here. Oh, I did have it loaded here already, June 28. But here's one on April 26. Let's take a look at this condor. So far so good, but now you're starting to move higher. And you get a exit taking signal here on June 15 for a loss. Okay, so you have a condor that ends up with a red RTI, and that means take your loss and move on. Okay, so we will now look at the Dragonfly for that same day, same trade. And look at that. You have a profit taking signal on May 31st. So the Condor ended up with a red RTI and a loss. However, if you had placed a Dragonfly that same day instead of the Condor, then you'd actually have a position that would have ended up with a profitable RTI signal. So I just want to point out the distinction at times between the Condor and the Dragonfly. The two big advantages to the Dragonfly are, one, you may get an earlier profit-taking signal compared to a Condor, or two, you may get a profit-taking signal when the Condor does not get one at all. And of course, the trade-off there is you have to accept a slightly lower um, target profit on a Dragonfly because, again, you pay money to buy this call and to buy this put. But you've seen in this case how it pays off because you can sometimes save yourself from taking a loss on a trade if you say we're in a condor. All right, so there's a good example. Here is something else I want to show you. Let me go back to the dashboard real quickly. I want to point out that what we've looked at so far are sort of what you call non-directional positions, or they might have a slight bearish or bullish tilt to them, skew as they call it. But of course, there are bullish and bearish strategies that are populated every day as well. You could even buy a condor if you'd like. We've done that occasionally. If you think there's a big move happening up or down, you could certainly buy put spreads, and you could just sell call spreads. But here's something called a bear hedge, and then here's something called a bull hedge, just the opposite. And I'll just show you what that looks like. If you're bullish, for example, on the stock market in general, maybe in this case, the E-mini S&P 500, or it could be the NASDAQ or Russell, take your pick. But let's say the broad stock market, you're bullish and you want to try to supercharge your returns, so we have something here called a bull hedge. And it's essentially, here we are right now. You buy a call spread, but to finance the purchase, you sell an out of the money put spread. So you take the money that you get for selling the put spread and you use it to buy a call spread. Oftentimes you can do it for a even money, so it doesn't cost you anything. So that's what it looks like here. I'll go ahead and just place one of these. Well, I'll do two, we'll do two of them. Why not? So that's really quite simply what it looks like. A bull hedge. We could have done a bear hedge just as easily, but here's an example of a bull hedge. Earlier this year, maybe you were bullish and you placed this trade. You can see here, you bought this call spread. So the blue line is a call that you bought, and the red line is the one you sold. And then that would cost you money normally, but because you sold this out of the money put spread, you received and collected money for that. And essentially the net result of this spread is you could place that trade with really not a lot of money out of pocket or at all. So I'm not even going to worry about the colors because they're different for when you're buying premium, but you can see how this trade was very, very nicely profitable as the market moved higher because this was a bullish position and you can see the market moved higher. So that trade worked out. And of course, it may not work out. And if that's the case, if the market starts going down, you have that short put spread, and that could get triggered for a loss in a red RTI. And that's how you would manage that. And here is a bear hedge. I kind of forget how this plays out, but just the opposite. Don't worry about the colors. So you might do this if you're hedging your portfolio, or maybe you're just wanting to take a speculative position. And you can see, of course, market settled deep in the money with these put spreads. But again, that's good in this case because you bought that put spread. You can see the P&L on that particular trade. All right, there's an example of that. And let me show you. Here we go. This is how you do it in the settings here. Under my account, under settings, and you can see the account settings. I'll show you. You want to check all these buttons here for the research and text messages. But this is how you activate the risk manager, the RTI. Here and here, you just check that box and then you save those settings. So then that will automate the exit signal, whether it's a gain or a loss. You'll be out before expiration. Unless you choose to roll the position or try to manage it that way, that's okay too. But you can have the RTI set it up automatically for you. And then here is a help file as well. And let me show you, I think it's, here we go, under glossary. You'll see all the color coding for the RTI right here. We're not going to go into the details, but and all the spread strategies are explained as well. But that's where you can get all the dynamics behind the RTI and how it works. And then there is also our daily research called TradeScope. So that's our technical outlook. You can see here analysis on the S&P 500. Here's the NASDAQ. A few tidbits from the day, the trading day, market outlook, upcoming economic calendar. Here's the federal funds futures, targeting probabilities for rate hikes in the next Fed meeting and so forth. So we do this every day as proprietary research only available to our clients. And then here is also our daily commentary. So this is people find this useful. It's all just on one page. It's quotes, any trades for the day, summary of what happened in Asia and Europe and in the US, and then looking ahead and in the economic calendar. So that's very handy and convenient all in one spot. And let me jump into, I've already showed you the help file, but also I want to show you this here. There are video tutorials on ThetaTrader, but you saw how easy it is. It is kind of, I guess you could say intuitive. And here's education as well on options trading if you want to dig a little deeper into spreads. But it's all available here in ThetaTrader. Everything is sort of user friendly, and that's by design, of course. All right, and let me jump back to the dashboard. Oh, and I'll show you this here too as well. On the dashboard, we noticed at a glance that you can see all of your short option positions and all of your long option positions, all in one spot. So that makes it very convenient. You can see at a glance what the colors are as well. So what we're going to do here is, in fact, I didn't need to go here at all, but that's okay. I just kind of wanted to point out, you can see everything's green right now, which is, well, not necessarily totally uncommon if you're selling premium and collecting premium um, like this, but oftentimes you'll have maybe, a yellow or orange as well in there. But you can see the open bot positions, they're a little bit elevated risk. Well, that's interesting because that's what the math says. When you buy options, the probability suggests that trade's really not going to work. And you can see the short options uh, tend over time to work well. And let's take a look here, at least in terms of the probabilities and the math. But what was I going to show you? Oh yeah, closed positions. So you can see all the closed positions on one page if you would like. So you can see here's 20 on the page here. There's 15 winners, 5 losers. And here's the point I wanted to make. 13 sold positions. In other words, where you sold premium and captured the premium, collected premium. 12 of those were winners, 1 was a loser. And out of the 7 you bought, 3 were winners and 4 were losers. Now remember, this is just a demo account. This is not indicative of what results you might expect in the future. I want to make that clear. I'm just kind of giving you an example of kind of how that math does seem to work over time. And you can see all the closed positions here. And you'll notice here's a bought put spread that lost money. Here's a long or bought call spread that lost money. And here's a short call spread that lost money. So there's one short option spread that was a loser. And then you can see the buying the call spread and buying the call spread lost money and lost money. So again, when you're buying options and focusing on buying options, you really have probabilities working against you. And I'll show you a little bit more about that in just a second. But here's an example. If you want a detail on this trade, you just click on it. You can go back in time. So you can see it's highlighted there. That was placed on June 13th. And that's what the graph looks like of the finished trade. And then you can go back in time and see here it was on June 13, 49 days till expiration. You were in it, turned green. Well, it was green the whole time, and then it turned blue, profit taking order and get out. So you can just see that kind of chopped around, and that trade worked out well. So again, this is just a demo account for illustrating sort of the whole strategy behind a lot of what we're doing and the I guess you could say the character traits of being short premium versus long premium. All right, very good. Now let me show you the best feature of all, at least in the opinion of I think most of our clients. And that's a real good overview of the ThetaTrader platform itself and how really how it takes something otherwise complex and really simplifies it. But let me switch screens here. All right, good. We're cooking with gas here. Here is what might be the best feature of all. These are trade alerts, and these are like more than, I don't know, less than 1 minute trade alerts. One touch response is all that's needed from you. You just touch your screen, accept or reject. And these alerts are live, meaning they are integrated with your AltaVest trading account. So that's why, they're so convenient. You don't have to read an email and then open up another platform somewhere and then try to copy in an alert. I don't know, you mistype something or you conflate or something. And we've had people say, oh, I had this trade alert thing somewhere else and I copied it wrong. It should have been a sell when it was a buy, and whatever. But you don't have that problem here. So you just touch accept and the order's placed. Here's a short little example. You'll receive a text message or an email or both, and you'll just touch the screen. It'll take you right to the alert. Of course, this is a few years old, but it all works the same. We've added a few features. In fact, that reminds me I should get a new video, but this makes the point. Here's an iron condor, and you can see there's a graph of the trade. There's the market trading. There might be a brief introduction to the trade like that. Here's an account number. Here's the net premium that's being targeted to collect, the cash required to do the trade. And look at this here. If you can see that, the quantity is pre-selected for you, where you can sell, in this case, 10 of these iron condor spreads at a price of $265. So it's pre-selected for you, pre-sized. So each trade is really tailored and customized to you and your account according to not only the trade size, but you will not receive a trade alert if you already have the same or a similar trade in your account. And you can see here, let me just, oh, what did I do there? You can see 71 days till expiration. That's your targeted annualized return on the position. And then if you like what you see, you want to accept that trade and place the trade, you just touch accept. Basically, it's like telling, well, it's telling your broker, yeah, I like that trade, I want to do it. So look at that one more time. Actually, we do have some new features on the alert service. One of them including you can modify the quantity if you would like. Okay, so there you see it. So there you have ThetaTrader, professional style option spreads available to the retail public, a growing retail crowd, I should say, becoming more and more powerful in the marketplace, that's for sure. But so let's see how we can get you involved with ThetaTrader and becoming a member so you can utilize our software and our services. So you have the ThetaTrader software. It includes everything we just talked about, the Theta trades, the RTI automation, and that trade simulator, valued over $3,500 for the ThetaTrader software. And then you add the trade alerts that you just saw the brief video. Again, these trades are tailored specifically to you and your account, depending on your account size and your open positions. And these are live alerts, again, integrated with your AltaVest trading account. You simply touch accept to place the order, or you just touch reject if you'd rather not. And then once the trades are filled, you can have the RTI automatically scanning your account every day and then triggering an order to close out your position when it hits a red or a blue RTI. So $4,400 value on that alert service alone. So to summarize, over $8,000 in value on that ThetaTrader software, but you have us to rely on and to lean on as well. So use us as your coach, your mentor. We are experienced, we're licensed, we've been doing this again for decades. Anyone you talk to here is a veteran, and we're not going to send you to a call center or some sort of chat bot. So you have a co-pilot, someone who's actually has a vested interest in your success. The better you do, the better we do. So we're cheering for you all the way. So you're going to have that co-pilot, that wingman, as they say, developing that relationship with someone who's licensed, discuss your trade strategy and history, value at least $7,500. I know people are spending $25,000 and more on education packages, and that's fine. I don't want to sound cynical because education is valuable, but what we're saying here is with ThetaTrader, it's all part of the package. So your ThetaTrader membership includes everything that you've seen, the software, the alerts, your private coaching valued over $15,500. And yeah, this sounds like an infomercial, but yes, there is more. I don't want you to forget the proprietary research. People really, really like to lean into this, the trade scope and the daily commentary. That's unique to us and us only here, valued at almost $3,000. And then I mentioned the online tutorials as well. So remember, those videos are always available within ThetaTrader. You can kind of self-direct yourself around there if you need a little um, brushing up on a lesson or two. So to summarize, ThetaTrader membership includes the software, the alerts, the coaching, the research, a value over $18,500. And I'm going through this step by step. I want to be clear because sometimes people say, well, does it include this? Is it that? Well, what about that? So anyway, it's not gonna. I'm not gonna obviously offer this to you at 18,000. But we did offer this ThetaTrader for $4,000 in live events, in-person events before the pandemic. So we'd have seminars. People would come to the seminars, sign up in the back of the room, and that was our price, $4,000. But we can do even better than that. We love doing these webinars and introducing people to what we're doing. People get very excited about what they've discovered. And in fact, we're going to do even better than this. $597 one-time price. This is the link, cf.altivest.com/TT. So go ahead and take a screenshot of that and or a picture or whatever you want to do. That's your link. And there's a 30-day money-back guarantee. So if you did sign up and something happened, you decide it's not for you, let us know. We'll just refund that membership. And again, that's a one-time payment. It's not yearly or whatever. So this is what it looks like here. That's the form. Just simple. Put your credit card in there, submit it, and that's it. That's my direct phone number. That's my direct email. And let me see here. I'm going to enter that in the chat box there, just so we have it, or you can click on it, make it easier if you need it. Must have my cap locks on, but yeah, I did. But anyway, I just sent that out. I didn't mean to yell at you with the uppercase cap locks on there, but you get the idea. So how about a few FAQs? And there are a few questions here. Yeah, ThetaTrader is AltaVest technology. That's correct. And depending where you are in Canada, let me know where you are. Send me an email or call me afterwards and we can talk. But sometimes accounts cannot be opened in Canada. I wish we could, but regulators are, I don't know, very protectionist. Let's put it that way. But thank you for those questions. Keep them coming. Someone asked, what's a introducing brokerage firm? We are basically registered with the NFA, a member NFA, and registered with the CFTC. That's what that means. So we're licensed and regulated. We're a brokerage firm. We're not just people selling a newsletter. Those people can say whatever they want. They're not audited. So anyway, tax efficiency. If you weren't aware of it, you can lower your tax exposure with your investing, trading, if you're trading in futures and options because they're tax efficient. For example, if you're trading individual stocks, and in this mathematical example here, you get a 20% return on 100 grand, you have a $7,400 tax liability. But if you're trading futures and futures options like what we do, you have favorable tax treatment. The longer term gains, you have 60% of the gains taxed at the long term cap gains rate, which is lower than your personal income tax rate typically. So you're going to save on your taxes basically. So that's the result here. It makes a big, big difference, people. You need tax efficiency. And there's also no more itemizing. You don't have to go through wash sales and all that. You get the 1099 with your P&L and that's it. But do consult your tax attorney or advisor. And why the E-mini options? I mentioned I would get to that. Well, Again, volume, liquidity, and access. CME Group says their study says they offer superior execution compared to SPX, a cost savings of $4 to $15 per contract. So you want those tight bid offer spreads. That's what they're referring to. Large market share, densely packed strikes, 100 annual expirations ensure granularity and coverage. So what they're talking about here is when our algo is looking for strikes to buy and sell, they are going to exist in the E-mini markets. If the algo is looking in individual stocks, you're not going to find them. They're just not available. So you can see here, here's some calls and here's some puts. Then as time goes by, the algo is looking for another set of calls, another set of puts, and another set of calls and another set of puts. So it's finding what it needs to build these trades and then to execute and get the trades filled as well. And then this is really important. With the E-minis, you can do a dragonfly with one order as one trade at one price. You don't have to leg in. Now, if you're doing stocks and you try to place a dragonfly, good luck doing that in one order. You can't. It has to be broken up into separate legs, two different legs to get in and out. It's very inefficient. And if someone knows of some platform that does a dragonfly with individual stocks, let me know. But I've looked and I've never seen one. So you have immediate access to these sophisticated option strategies that, prior to a lot of what we're doing here just weren't available for your typical retail trader. That's what the E-mini futures options allow you to do with ThetaTrader. So remember, this is how rookie options would trade options. We're back to our friend here. In 2021, 11% of Robinhood active users made options trades, but of that 11%, less than 1% actually made a spread trade. Imagine that. So basically, anyone on Robinhood is just buying options. They're buying calls all the time. That's essentially what they're doing, or maybe puts, but probably mostly calls. So if you only buy stock options, remember, theta or time is always working against you. And that's the title of that video, by the way, for that woman is on CNBC. There she is. I forgot her name, Yun Lee. So she says here the appeal for retail investors to buy options is that they're much cheaper, but potential for profit is actually not that high. So what she's referring to is they just have a high likelihood of expiring. So more advantages, you can track just one or two markets with the way we do it. Again, we're just doing the stock indexes. Margin use versus stocks is efficient, and there's a clear cost structure. It's not hidden. There's no hidden cost with what we do. We're not trading securities options. Everything is electronically traded at the Globex electronic exchange at the CME Group, the largest futures exchange in the world. Every order is equal treatment. If you're going to do one order, one quantity, or 500, everything flows through the same place and is treated equally. So there's no payment for order flow, ridiculous nonsense with what we do. They talk here about Robinhood. They're selling customers the idea that trading is commission free. Turns out that orders are executed at prices inferior to other prices or other brokers. So payment for order flow is disguised commissions. So if you want the broker to work for you, simply pay a commission. So what they're referring to is when you place an order with, I'm just going to pick on Robinhood, but anyone that says free commissions, when you place that order, they don't fill your order. It's being sold to a third-party market maker, that order flow, so that they fill the order, and then the order flows back to you. But they're filling that order and they're paying Robinhood for that privilege of filling the order because they can take the spread. So you're getting worse fills, is what they're saying. So none of that with us. Our commissions are straightforward, 5.25 round turn. That's all in. And other published rates you might see in big box brokerage firms might look cheaper, but it's always per side. And then they add more fees on top, like clearing and exchange fees. So our rates are very competitive. When they add all that up, it ends up being more than what we charge in some cases. So our rates are competitive. ThetaTrader, everyone performs differently because everyone trades differently. It's a self-directed platform. And again, I want to point out everything is net. Everything in ThetaTrader is net of all trading costs. I mentioned that earlier. What size of account? Well, if you want to have various dragonflies and condors in the account simultaneously, 25,000 is really probably the minimum. If you want a free membership, people love this here. We'll rebate 50% of your membership if you have a 50,000 to 99,999 account, or 100% rebate, $100,000 or more in your account. We'll gladly rebate that membership fee. And who doesn't like something for free? I mean, people, every time we do a webinar, we definitely get people taking us up on this one. So you'll want to do that. Any kind of account, we can do them, IRA, individual, joint corporate trust. People sometimes do two, whatever it is. And why would you even consider ThetaTrader? And I'm gonna get close to. I have time here. I left time on my schedule to do this, but I don't want to keep people forever. But and keep questions coming. Let's take a look here. This may improve diversification and lower portfolio risk. That's why alternatives are important. But risk of what? Well, how about inflation? It's still way above the Fed's target, and it might even be coming back. Liz Ann Saunders says the prices paid component in the Philly Fed Manufacturing Index was among the larger increases on record. You can see here. Commodity prices remain inflated. This is the CRB, Commodity Research Bureau Commodity Price Index. So we're coming off the highs, but we're still highly inflated. Wages are not keeping up with inflation. This is true. Long-term inflation is 4 or 5% every year. Everything doubles in price every 14 to 15 years. So don't believe all the CPI headline numbers. They change them. I think they've changed them like 20 times in the last decade, or something like that. So they just change them and get the answer they want. So anyway, Fed pivot's probably a long way ahead, folks. Now this is interesting, and I'm just going to give you an outlook here for the near term. This is kind of what we're looking at, what we're thinking. If you have a different outlook, that's fine. You can use ThetaTrader and trade any way you would like. But I think it's important to keep in mind what's happening. So some of these indicators projecting the stock market decline, which ones are they, and can they be trusted? And we talked about noise earlier, but this is really a lot of just data and math, not really opinion. So this leading market indicator has never been wrong. Do you know what it is? Who knows what that is? Who knows what I'm going to mention here? Let's take a look if anyone's going to make a comment on that. Well, you can, well, let's see here. Is that coming in the questions? Well, anyway, I'll keep moving forward here. I'm having trouble finding my chat versus my questions. But so the answer is the Conference Board's leading economic index, or the LEI. At least historically, it's been foolproof. Hasn't been wrong in 64 years. So the LEI is nearing a decline of nearly 8%. An annual contraction in the LEI of 4% has always represented a definite recession coming. And we are likely to be in recession from Q3 of this year to Q1 of next year. And then it's meaningful that stocks have a history of performing poorly immediately after the start of a recession. It hasn't been wrong one time in 64 years, signaling stocks are more than likely going to head lower. Here you have leading economic indicator signals economic activity likely to decelerate. And this is from the Conference Board. These are not people selling you clickbait. These are real boring people saying this up. Tumbled for the 16th straight month. And here's what it looks like on the graph. Here's where we are. So we're in this negative. Anything below this line here is negative contraction territory. But you can see when it gets down negative, what happens subsequent to that? Recession. That's the gray area. It goes negative, gray area, recession. Negative, another recession. So we're due, folks. Consistent with a 20% drop in the S&P 500 EPS. So that's what's happening here with the LEI down where it is. People say the economy is recovering, but it might even be on credit cards and savings. credit card balances, student loans, consumer situation deteriorating. This was on Macy's just the other day. Undermining discretionary spending all year with credit card delinquencies and credit card revenues, credit card balances, student loans, auto loans, mortgages, customer coming under pressure. These are the new realities. The increase in rate of delinquencies faster than planned, rising bad debts. So I know that's just at one retailer, Macy's, but you're hearing that a lot. Look at Foot Locker this morning. I think they were down 15%. Student loan repayments are resuming. This is interesting. There's been 39 months of deferred payments, over $15,000 in deferred payments, which was discretionary income, and now it's not going to be starting, I think, in September. First time ever credit card debt over $1 trillion. Household savings, look at this here, exhausted. So I'm not trying to say the world's ending. I'm just saying that we're really set up for a recession, folks, and stock market is not going to like that, at least according to all the data. Credit card interest rates above 22% average. That's a record high. Here's another 100% accurate recession indicator. The yield curve is inverted. Again, these are real boring people at this and that institute expecting a serious economic event, deepest inversion since 1981. And again, sort of like the LEI, you can see the gray bars. When the yield curve goes negative, you get these recessions right afterwards. See, and here, and then there, and then again. So we're headed in that direction. It says here, all 8 U.S. recessions were roughly a year in advance, predicted by the yield curve inversion. It's a perfect indicator. The current inversion will likely be long and deep. The next recession will be relatively more severe, but it may extend into 2025. Looking at housing data, affordability index in the second quarter, it's the worst on record. Housing payments here, record highs. And looking at the stock market in general, yeah, we've certainly had a big run this year, but it's really based on a handful of stocks. The AI narrative and story. Nvidia, exclusively long tech stocks. Algos chasing the market higher. Beware of momentum stocks. So on and so forth. This is kind of funny. People have gotten rich off this market. They think they're invincible. I think there's some truth to that. This was interesting just the other day. I want to point this out about the NASDAQ. On Monday, 75% of the SPX gains were from 6 stocks. And then 1/3 of the NASDAQ is represented by just 5 stocks. So not a lot of market breadth. And I don't want us to all think being negative and cynical on trying to make money in those environments, but it can be damaging too if we all tend to think we're really smart by catching some of those moves. This was just yesterday too. This guy here, Eli Salzman, he says there are times you want to bet against consensus, and now is one of those times. It's going to get worse. He manages a large cap value fund. He says his recession is on the way. And why should we listen to him? His $12.6 billion fund has outperformed the market over the past 3 to 10 years. So he's a performer, and it comes from his out of consensus forecast about macro trends. By looking at his current cautionary stance, the economy is heading south in the next 6 to 9 months. Make sure your portfolio is defensive and protecting on the downside. The downside isn't going to be pretty. And he gave 3 reasons. Monetary policy takes 18 months to impact the economy, and now it's about to hit. The inverted yield curve continues to predict recession and inflation higher for longer. So he kind of is referencing some of the items that I referenced just a few minutes ago. So hopefully we can all get prepared. We don't want to just be passive. We think it makes sense to diversify what you're doing with alternatives. Some of these automated and unique option strategies, you can either speculate or hedge your stock portfolio. Have a slice of your investment portfolio allocated to some of these alternatives. So again, the ThetaTrader membership, the algo-driven software, the automated exits, the trade alerts, and the personal coaching, that's all part of your membership. Simple 5 steps here to get you going. You complete that order form with that link there. You'll soon get your login credentials for ThetaTrader. You can use it in demo mode. And meanwhile, you'll get an email with a link on how to open your trading account. And then once that's open, you fund the account, usually with a ACH transfer or bank wire, and then you can start trading. Just that simple. So again, you got those amazing algo-driven options trades, and you have strategies for bullish or bearish or non-directional market conditions or whatever outlook you want to bring to it. And again, that trade simulator, you saw, really, that's a really great feature. People spend a lot of time on that. It's a lot of fun to go back in time too. You can pick any date, and you can use that button here on the end just to go directly to the end. You don't have to play it step by step each time either. And those one-touch trade alerts there, get them right there on your phone or smart device or email as well. So there's that discount available through Friday night, so it does expire. So I'll leave that up, and let's see here if there's any more comments or questions coming in. Yeah, we mentioned about the Canadian one already. Yeah, and ThetaTrader is owned by us. That's correct. And let's see if there's any other questions or comments. Or does anyone want me to go back into the platform and show you anything in particular? Or actually, I probably should wrap it up soon because I don't want to keep you here too long. Thanks for your patience and being with us. But hopefully I know I have fun doing these, but hopefully you gain some valuable insight along the way. And all right, I think if there's nothing else remaining here, let me just double check one more time. Let me enter that one more time here without yelling. And I'll add my email. And then my number. Okay, so in the chat, I've put all our information there, contact info. I'm available. That's what I do here. And see if there's anything else I didn't get to. Or anyone has their hand raised. All right, folks, I think that's going to wrap it up. And thank you for joining me. And that was a lot of fun. And I do always enjoy hearing from you. So feel free to call me and I can gladly chat with you. And you can pick my brain and all that good stuff. So we'll keep in touch and have a great day. Bye-bye.